Hey boys, I hope you're all doing really well. So yes, let's move on to the next discussions of our CA final preparations. We are today discussing the RTP series of the CA final direct tax syllabus. This RTP is for September 2025. So yes, all my friends who are writing September 25, this would be a video for you to go through the RTPs along with me to see what is happening in the paper discussion. But here is the thought for all those people who are writing September exams. Let's be mindful about the fact that your May 2025 RTPs are equally applicable to you. Since your syllabus is not changed from May 25 to September 25, you can very well rely on the May 25 RTP as well for a good practice. Now, as much as I'm going into the September 25 RTP, before I start, I always tell this one thing to all of my warriors. Please note that this RTP series discussion is only for me to come and tell you how the answers look like. This is in no way coming and telling you that you don't take efforts from your side and you just directly start looking at the video. If you have not done this earlier, people, I would request pause the video, go through the RTP once again from your side, see what kind of questions has been asked and see if you are able to answer it from your end. If there is any kind of miss outs happening from your side, that's when you look into this RTP to understand what exactly is the way to approach this. So please consider this RTP as a test paper for yourself to discuss and understand how this RTP should look like. Yes. Why am I telling you this? Because one of the most beautiful RTPs I've seen, this RTP covers the whole statutory updates which ICAI spoke about. Yes, the detailed statutory updates which we have discussed in the previous videos has been very nicely covered into this RTP along with all the amendments and everything. So very good RTP for you all to discuss along with me. If you have not watched the statutory update series, please do that first, because without doing the statutory updates, you will not be able to answer many of these questions in the RTP series. So yes, focus on the statutory updates, focus on the judicial updates. There's two videos which is already available. Please watch those videos, get those background understandings, and then look into this RTP series in order to understand this better. Are we clear? Yes? Okay. With that understanding, people, we're going to look into this RTP series. Let's try and understand what kind of questions ICAI has asked you for your September preparations. First, like always, it always starts with something called as your case study questions. So we're going to look into the case study questions, but before we go into the case study questions, let's try to understand what kind of questions have been asked. Yes, this is the standard way to approach people. So I'm looking at the questions and we'll go from there. First, question says, from which of the following assessment years can the company validly claim rollback benefits under the APA provisions? So they are asking you that you're going to do some rollback provisions and they're asking you which periods of these will be eligible for APA rollbacks. Now there are some conditions in APA rollback. So we'll look into the question and we'll try to figure it from there. Question number 2 says, what is the time limit for filing the modified return of income in respect of rollback years? So we have been asked the time limit. Now ideally, even if you don't know the MCQs, I should be able to answer it from here itself. It says within 3 months from the end of the month in which the original APA was filed. Definitely not possible because you're going for rollback. Second, within 3 months from the end of the month in which rollback agreement was signed. Yes, this looks like the right answer. But within 6 months from the end of the financial year in which the original APA was signed. Now here comes the question. Are we looking at the rollback from the original APA or from the new APA rollback? The answer would be B. The answer would be B. I would always be looking at from this period only, people, because if I'm going to apply for rollback only now, I can only apply for a return filing conditions from this period. I cannot be imagining what is happening in the original return. So I can come and say option number B is the right answer right straight away. Yes, great. Which of the following statements is correct with regards to the adjustment of APA? We will have to figure this out. I think there are some 855 and 580 numbers, so we have to figure that out. How much is the amount of tax deductible at source by Sugam Limited? Okay, TDS related question. In which of the following business connections would not be established for Fiber Inc. in India? Opening a branch in Pune for carrying on business in India, definitely business connection. Opening a license office in Delhi for finalizing the contracts for supply of raw materials, business connection. Option number C, appointing Mr. X as an agent in Kolkata for interacting with potential customers for promoting company's products. Mr. X is acting as an agent in India for several other companies which are not related in any manner. And point number D says appointing Mr. Y as agent in Mumbai for finalizing contracts with the customers on its behalf. Mr. Y is acting solely for Fiber Inc. Now people, for those who have seen through business connection in section 9, there is a certain condition for agency concept. An agency comes and says that if you are a dependent agent, then it is a business connection. But if you are acting on behalf of many customers, then there is no dependency happening and therefore there will not be any business connection. So here again, without even going into the case studies, I should be able to answer it as option number C. Great. What would be the quantum of penalty leviable by Sugam Limited for failure to maintain books of accounts in respect of its transaction if Midland Limited has been requested for? Okay, so we're going to hold this back. Let's look at the case study. Let's see what we can answer from the case study questions. Sugam Private Limited in Mumbai is engaged in the manufacture of ceiling fans and exporting the same to various associated and other enterprises worldwide. So which means I'm going to do transfer pricing related concepts here. The income tax assessment for 22-23 has been completed by making a reference to TPO, who has enhanced the arm's length pricing by 855 lakhs. I saw this number somewhere in question number 3, so we're going to keep this in mind. The company applied for an APA in March 2024, which was signed in July 2024. Okay, original APA. The tax assessment for 21-22 regarding ALP of the international transaction was disputed before the tribunal, which has set aside the order for fresh consideration by assessing officer in June 2024. So 21-22 has been gone to ITAT. ITAT has remanded the case back to the assessing officer for fresh considerations. The company has also applied for rollback benefits, which was agreed and signed in December 2024. So this is the rollback benefit they were talking about. The 3 months will start from here. If the APA is applied, the ALP determined by assessment year 22-23 would get enhanced by 580 lakhs as against 855 lakhs original determined by TPO. Here comes the question number 3. The question which has come up is, during your return filing, you may have reported some income. This income was announced as 855 lakhs by the assessing officer, but during APA, it has been promised to only keep it as 580. In that case, will you go for 580 or will you go for 855 becomes the important question. Let's see what exactly are the questions given to you. Question number 3. People, we have already answered question number 2. Question number 2 is option number B, so we are moving forward. Right? Which of the following statements is correct regarding the adjustment of ALP? ALP adjustment of 855 lakhs to be made for 2023, as the adjustment based on 580 lakhs results in reduction of total income of the company compared to TPO's adjustment of 855 lakhs, thereby disqualifying rollback provisions. No. Understand, when it comes to APA rollback, the condition is only that you should not go for an income lower than what is filed in the return of income. Return of income is the only restriction here. There is no restriction on anything other than that. So which means you are permitted to reduce the assessing officer's income by an APA provisions. ALP adjustment of 580 lakhs has to be made for 22-23, even though it is less than TPO's original assessment, since it does not reduce the total income as declared in the return of income. Yes, option B looks right. ALP adjustment of 855 lakhs has to be made for 22-23 as rollback provisions cannot be applied. No. ALP adjustment of 855 lakhs has to be made. No. This is not the answer. Option number B looks right to me. Yes. Great. This brings me to question number 1. For which of the following assessment years can the company validly apply for rollback benefits? Now, people, when it comes to rollback benefits, the rule is that you can apply for the last 4 years. When did he find the original APA? The person has filed this APA in the month of December 24. So which means 24-25 and 24-25 will not be considered. Prior to this 24-25 can be taken up for APA rollbacks, which means I can take for financial year 23-24, financial year 22-23, financial year 21-22, and financial year 2021. Now this is me talking in previous year terms, so the assessment year will automatically be extras. Yes. Now here comes the question: have they given you any restriction for 23-24? No. So therefore eligible. 22-23, no, therefore eligible. Understand, 22-23 previous year has not been given. 22-23 AY has been given. 22-23 AY we just discussed, people. There is an adjustment which is going to be reported as 580 lakhs. This is perfectly permitted. Therefore 22-23 assessment year is perfectly fine. Comes the question of 2021. This 2021 is what we have to discuss, because understand, 2021 or assessment year 21-22, tribunal has passed this case for a remand report and has sent it back to the assessing officer for fresh consideration. Now, let me clarify certain things to you. As per APA rules, if the matter has been disposed of by the tribunal, then it is not eligible for APA. That is what the condition has been given. But notice this question carefully. Has the matter been disposed of? No. It has not been disposed of by the APA, but rather than that, a tribunal has just passed it on to the assessing officer for fresh consideration, which means the matter is still open for debate. In such a scenario, I would come and say that the assessment year 21-22 is also eligible for APA rollbacks. Assessment year 21-22 is also eligible for APA rollbacks. This is fairly coming from one of the previous RTPs, people. There was May 2024 RTP, if my memory serves right, where the same question was asked, and the same question in theoretical format was confirmed, saying that ITAT simply remanding the report back or setting aside the order does not tantamount to closure of this, and therefore APA rollback can be eligible for. In my view, the answer should be option number A. The answer should be option number A. However, let me be cognizant. If you actually go through the answers, you will find the answer as option number D. You'll find the answer as option number D, because in this RTP, ICA has made an assumption saying that 21-22 will not be eligible because the ITAT has disposed the matter of. Are we correct here? I would say no. Understand, same ICA on May 2024 RTP has come and confirmed that you can claim for 21-22 as well, and therefore there seems to be some sort of mismatch. I believe ICA will come back with a corrigendum at a later stage. So this stage, I would say the answer should be option number A and not option number D. For those who have a confusion, please refer the May 2024 RTPs. You should be able to get this answer from there as well. Great. So I think we have answered question number 1, question number 2, question number 3. Let's look at the next part of the paras. What is question number 4? Question number 4. The agency has already been answered, people. We've already taken care of that, so that's not a problem. Sugam Private Limited has borrowed 100 lakhs from Triple Link USA on 1st July 2019 under a loan agreement which is approved by CG. Yes, so this looks like an interest income. This looks like an interest income. Interest is payable half yearly in respect of the foreign currency at 4% per annum on every half a year. That means 31st December and 30th June. For the half year ended 31st December, interest was paid on 28th February 2025 after deduction of tax at source. The TT buying rates are given to you for 31st December as 72, January as 73, 20th February as 72.5 and 31st March as 74. Now, let me explain this once again. For those people who have gone and seen the videos of the past where I have prepared a cheat sheet for non-resident taxation, we had come and confirmed saying that when it comes to non-residents, if a non-resident is receiving any interest income from a loan arrangement before 2023, any loan arrangement which is happening before 2023 would have been liable for an interest at the rate of 5%. Tax at a rate of 5% of interest. Tax at the rate of 5% of interest. Now notice this carefully. This is a loan happening in 2019 and therefore this is liable for a 5% tax rate. Keeping that in mind, let's now understand what are the incomes I have. I have 100 lakhs worth of income. On this 100 lakhs worth of income, I'm going to be taxing 2% people, because understand the question is coming and telling they have 2 half-yearly installments, and if I understand the question carefully, the question came and said they want only the interest income of 28th February. So they're only looking for the half-year interest of 31st December here. Yes, so it is 100 lakhs into 2%, which gives me 2 lakhs. Yes, so I have 100 lakhs into 2%, which gives me 2 lakhs. 2 lakhs USD is what my income is. Notice carefully that this interest is due for me on 31st December. It has just paid to me on 28th February. Is the payment criteria of 28th February going to be relevant for my TT buying rate? Answer is no. Rule 128 will come and clearly come and clarify to you that when it comes to section 115 and rule 128, when it is an income would be treated as the conversion on the date on which it is due. On the date on which it is due. So 20th February, even though it is the payment date, has no consequence to me. My consequence is only going to be when I received the income. In this case, I have received the income on 31st December and therefore 31st December rate would be taken, which becomes 72. So if I multiply this with 72, my answer becomes 144, which means 1 crore 44 is what my income looks like. With the income being 1 crore 44 people, how will I be taxing it? 1.44 crores will be taxable at the rate of 5%, will be taxable at the rate of 2% surcharge and a tax rate of 4% cess. Yes, so I have 5% of tax, I have 2% of surcharge, and then I have 4% of cess. So let's check this out. Into 5% plus 2% plus 4% gives me 7,63,776 rupees. So therefore, option number A is right here. Option number A is right here. That is how you have to report this. Yes. So how did we do this? We said 100 lakh worth of dollars multiplied with 2% interest rate per annum will be multiplied with 72 rupees per dollar, will be multiplied with 5% tax rate. Adding up on this, you will have 2% surcharge rate because you have gone beyond 1 crore. Adding on to this, you will have 4% cess rate, and therefore you will arrive at the answer as 7,63,776. Clear? Beautiful. Great. I think we're done with this. That leaves me with the last part of the case study. Sugam Private Limited has exported his products to unrelated party Midland Limited. Notice this carefully. I see that the person has done this export to unrelated party. Sugam Limited did not maintain prescribed documents and information in respect of the sales made to Midland Limited. During the financial year, the aggregate sales made by Sugam to Midland is 12 crores. People understand transfer pricing provisions only apply when you do transactions with related parties. Associated enterprise is required. If it's an unrelated party, what do I care whether you report the books or not report the books? This will have a separate implication when you talk about section 44AA. 44AA is what I'll be impacting you. I would not be impacting you on just because not having transfer pricing documentation for an unrelated party. So will I have any penalties on this? The answer would be no. No penalties are coming on this. Answer is nil here. The answer is nil here. I would not be reporting any penalties. Assuming this would have been an associated enterprise, then I would have reported for a 2% of the value of transaction as my penalty. So option C would have been right, but otherwise this is option D. Clear? Great. Case scenario number 2. Case scenario number 2 comes from your statutory updates. Yes, the topic which I looked from the statutory updates, and I told you people to be focusing very importantly, the compounding of application, new amendments after October 17, 2024. The whole topic is actually already covered in your statutory updates. The same examples has been given to you, so you just have to focus on the examples. You'll get the answer accordingly. Yes, let's look at the question. As I look at the question, I'll give you the answers better so that you understand this better. What are the questions? As per the guidelines of compounding of offences, how will be the application dated 20 July 2024 pending as on 17th October be treated? People, the compounding application had come and clarified that if there is any application which is pending before 17th October, it will be considered as if a fresh application has been made under the new guidelines. Yes, so we will proceed as per the new guidelines and it will be assumed it as a fresh application. Option number A, it will be treated as debarred. No. It will be disposed of as per previous guidelines. No previous guidelines and all. It will be treated as first application under the revised guidelines and no fees is required to be paid. Answer is yes. It will be rejected automatically. No, you cannot reject things like that. So therefore option number C looks right. Yes, this is something which I always tell in the classes also, people, that when you look at case scenario questions, the biggest mistake students end up making is they start reading the paragraphs. Sometimes you can actually answer the questions just by looking at it also. So you don't always have to look at the paragraphs for you to answer those questions off. You should be able to answer it like this also. What is the rate of compounding charges to be applicable on compounding offence for 23-24 included in consolidated? We'll have to check this. Rate of compounding charges applicable on compounding offence for 16-17, we have to check this. What is the compounding charges for application filed on 276B? Definitely have to be checked. Whether application of compounding offence can be filed for the third quarter has to be looked into. So let's check that as well. Yes, so let's look at the question now. What exactly is the compounding looking like? Timely Payment Limited is engaged in manufacturing and distribution of locks and watches. The kind of sarcasm ICI uses, I tell you, it's Timely Payment Limited and is doing prosecution here. It has committed multiple offences over different financial years and the details of the offences are given to you as under. Yes, kind of ironic on this. Application status is 2021, compounded offence under 15-16, done dusted matter, people, not relevant, ignore it off. 15th December 2022, compounded offence for 276-6, again done and dusted matter, not important. 2023 has been rejected of compounding application for 276B for 16-17, rejected due to non-payment of taxes. Already rejected, people, not relevant, but notice carefully, this is not a serious issue. Just because you have not paid the tax and it has been rejected off, you will be eligible to file a new application once again. Yes, so this will be just a pure defect which can be reignited once again. You should be able to file it once again. 2024, on July 2024, this is what we answered just now, people. If it is pending, I can treat it as a new application under the current laws. So perfectly permitted. 276C has been taken into consideration. On 15th November 2024, there is a consolidated application which has been filed for covering 16-17 276B. The same offense, people, the one which got rejected here, they filed it once again. Can they do so? 100% yes, no doubts about it. Offense for 276C for 21-22. What is 21-22? Do I see it for the first time? 276C is coming in for the first time. Yes, this is my first application. This is my first application of offense. 275A for 23-24 again looks like the first application of offense. Oh no, once again, 276C I have already disposed of here once. Yeah, it has been disposed of once here, people. So therefore, this will be my second offense, whereas this will be my first offense. New application has been filed for 276B on 22-23, prosecution initiated on 2023. 276B, I remember seeing it earlier. Yes, I see 276B here. I also see 276B here. So there are two 276Bs, people, which means this is my third offense. This is my third offense. Now, Rahul, why are you wasting time writing offenses and all? You'll understand if you have read the statutory updates properly. So we'll focus on that. Let's look at the next part. Other relevant facts: all dues, including tax, interest, and penalty, has been paid before the filing of application. Good enough. Necessary applications and undertakings has been agreed to withdraw the appeals. Good enough. Compounding application of 50,000 and 25,000 was paid for consolidated and single applications. MCQ question which I told you during statutory updates also, people. If they want, they can ask you a question as to what is the fees which you need to pay for the application of compounding. It is 25,000 if you are going for a single application and 50,000 if you are going for a consolidated application. The company is delayed in depositing tax deducted at source for the first quarter on 24-25 for 1.25 crores for 135 days. However, no prosecution proceedings yet commenced for such offence. Company has paid all TDS, interest, penalty, etc. Assume that the normal compounding charges in each of the offence is going to be 45,000. So they have said that if you are going for compounding, they are going to ask you to pay 45,000 on each of the offence. Keeping that in mind. I think 7th we have already answered, so that's okay. Question number 8. What is the rate of compounding charges which will be applicable on compounding the offence of 275A included in the consolidated application? People looking at 275A. 275A looks like the first fault. Yes, 275A looks like the first default, and therefore because it is the first default, I am eligible to pay the normal compounding charges. Also people, there is a separate condition which we would have discussed. When a prosecution is launched on you, you have to make the compounding application within 12 months, because if you make the compounding application post 12 months, then you have to pay an additional 50% fees as an extra money. Since this is 23-24 and I have made the application in November 24, I am within 12 months, so normal charges would apply. I would not be penalized for anything else. Yes, so therefore the answer is going to be A, normal rates is applicable. 9. What is the rate of compounding charges shall be applicable on compounding the offence of 276B applicable in the consolidated application? Now people, 276B, if you notice, one application has been made here. The second application which was made here got rejected. Normally it's a process that even if it's a rejection case, that will be treated as a second application. However, the guidelines come and mention that all applications which are filed before 17th October, even if you have filed 5 different offenses, 5 different applications, they will all be consolidated together and will be called only as one application. So even though there is 2 applications done before 17th October, these 2 put together are being called as one application. Yes, on that understanding, the next application which is filed for 276B will be called as a second application. I want your attention on this, people, and very careful attention is that if at all it would have been that the rejection would have happened after October. If the rejection would have happened after October, the first, second, and this would have been the third offense. But since the rejection is happening before October, it is important that you consolidate both of them and you show it together. If you consolidate both of them and show it together, it will be called as one application, and therefore this becomes my second offense. As much as this is my second offense, income tax comes and says the moment you touch a second offense, you're only liable for 1.2 of the normal charges. So you'll have to end up paying 1.2 times of the normal compounding charges. 1.4 will not be the case. 1.4 will not be the case. Will it be not compoundable? Answer is no. Understand? It's just a mere defect. It's just a mere defect. For non-payment of tax, I cannot be coming and penalizing you. You can file a compounding application. Next, what will be the compounding charges for the application filed for 276B in 22-23? What 22-23 are we talking about? We are talking about this one. We're talking about this one. This is the application. Now understand, people, this is the third offense. With this being the third offense, because originally 2 became 1, the one which you filed in consolidated became second, and this becomes the third application. With the third offense, it now goes on a GP model. We discussed about it. So it becomes 1, 1.2, 1.4, 1.6, and so on and so forth. So this one will be liable for a penalty of 1.4 times. But notice carefully, the prosecution was made on 2023. The rule comes and says that if you're going for a prosecution in 2023, they should have filed the application within 12 months. Look at the date. The date is December 24, whereas application is filed in August 23. So which means if you would have filed this application before August 24, I would have given him a normal 1.4 rate. But because he has filed this application post 12 months, I will have to now add an extra 50% on this. This is a mandatory criteria. Yes, on that understanding, how much am I going to be taxing? I think the normal charges were 45,000. 45,000 may you add another 50%. So it becomes 67,500. This gets multiplied for 1.4 times, and therefore the answer should become 94,500. Option C is the right answer. Yes. So how does this get operated? It is 45,000 into 1.5. Why into 1.5? Because I'm adding an extra 50% into 1.4 for the third offense as a charge. Next, whether application for compounding of offense can be filed for third quarter. Now people, what is the third quarter being talked about? The TDS default. Notice the question comes and says no prosecution has been launched. Here comes the question. When no prosecution has been launched, can you still go for a compounding? Answer is yes. 101% yes. You can suo moto go for a compounding as well before even the proceedings are launched. There is no such default here. No application can be filed. No application can be filed only after initiation of prosecution. No. No application can be filed. Cannot be filed for an offense related to delay in deposit. No, there is a compounding available for delay in deposit of TDS also. Yes, application can be filed even if the prosecution proceedings are not commenced. Answer is C, option number D. Since company has already paid the TDS, no further action is required. No, definitely not. Just because you have paid the interest and tax does not mean that you cannot be prosecuted for it. You can definitely be prosecuted. So option number C becomes the right answer. Clear? Yes, great. With this, people, we are done with the case study questions. I think the other questions should be fairly easier. So let's look at it quickly. Question number 12 says, a search is conducted by the Income Tax Department in India in the premises of Mr. Surya Prakash on 25th March 2025, and it has come to the notice of the department that Surya Prakash has earned income to the tune of 5 lakhs in country X during the previous year 2021. People, this looks like Black Money Act. Yes, so we are looking into Black Money Act. Further, income tax department noticed the existence of undisclosed gold jewelry during the which was purchased in 21st April 2022. Neither this income nor the asset in question has any bearings to the income taxable under the provisions of Income Tax Act. Very obviously, people, because Black Money Act comes and says when something is covered under Black Money Act, income tax will not have an overriding effect. The jewelry was purchased for 4.2 lakhs. It has been valued for the report recognized by the valuer as 5.2 lakhs on 1st April 24 and 5.3 lakhs as 25 March 2025. Yes. Which of the following statements is correct with respect to the taxability of the impugned items in the hands of Mr. Surya Prakash under the Black Money Act? Both undisclosed income and undisclosed assets will be taxable in 24-25. Now, I want your attention here on this, people. When it comes to this, the logic is very simple. The logic is very simple. Black Money Act comes and says when you are aware that there is an undisclosed income, it is going to be taxable in the same year in which it was found for. Which means, in my case, if you look at it, the undisclosed income pertains to previous year 2021. And therefore, it will be taxable in previous year 2021. On the contrary, when it comes to undisclosed assets, I cannot be taxing you in the year of purchase because it's an asset. I need to be taxing the income, and therefore they are taxable only in the current year in which the case has been found out. My current year, the case has been found out on 2025. So I am in 2025 and the current year the case has been found out. So I will be taxing the income in the respective year of 2021 and I'll be taxing the asset in the current year of 24-25. Let's keep that in thought. Undisclosed asset is taxable in 2023. No, people, you cannot be taxing the asset in 2023. It's not possible. Undisclosed asset is taxable in 2024-25. Yes. Undisclosed income is taxable in 2021. Yes. When I have the identification of the income, I tax it in that respective year. When I have identification of asset, it is taxable in the current year. Next, the value of the undisclosed asset is 4.2 lakhs. Now, people, when it comes to Black Money Act, the rule is very simple. The rule comes and says that I will be taking the black money income as the fair market value of the asset or the actual purchase price, whichever is higher. In my case, my purchase price is 4.2 lakhs and my fair market value has to be decided between 5.2 lakhs and 5.3 lakhs. The answer is very simple. It is 5.2 lakhs. Black Money Act comes and says it is as on the 1st April of the previous year in which the search has been conducted. The search has been conducted on 25 March 2025, which means 1st April 24 is the consideration value. So it is 4.2 versus 5.2, whichever is higher. So therefore 4.2 is not the right answer. 5.2 looks like the right answer. 5.3 cannot be the right answer. This means 3 and 5 should be the right answer, and therefore option C makes sense to me. So what is the summary of this, people? When it comes to Black Money Act, undisclosed income will be taxable in that respective year. Undisclosed asset will be taxable in the current year when the search has been conducted. What is the value of the asset? The asset value will be FMV or your actual purchase price, whichever is higher, but FMV will be as on 1st April of the previous year. That is what the understanding would be. Clear? Sweet. Let's move on forward. Peter PT Limited, a Singapore foreign institutional investor, FII. Okay, section 115 AD is coming into picture. Is a subsidiary company of Zoom Limited based on UK Peter PT Limited. Based on UK full stop. Peter PT Limited has commenced its activity in India from 1st December 24, middle of the year. On 31st March 25, it has earned a short-term capital gains of 70 lakh rupees on transfer of listed shares of an Indian company on which STT has been paid. People, short-term capital gains STT paid would mean 111A. If it is 111A, I'm going to be taxing it based on a decision of before 23rd July or after 23rd July. Question says it is after 23rd July, so I'll be taxing it at the rate of 20%. Yes. Now, how much of the tax payable by Peter PT Limited on short-term capital gains of 70 lakhs? People, this is a company and therefore there is no surcharge applicability. Surcharge applicability would have come only after 1 crore. This is only 70 lakh rupees and therefore I don't have any surcharge applicability. I can let that go. So with that understanding, people, what is the incomes to be taken into consideration? So I have 70 lakhs multiplied with 20% plus another 4% says my answer should become 14.56 lakhs. Yes, so my answer should become 14.56 lakhs. This one is easy question, amendment question, but an easy question. You should have been able to answer this question. Great. I think that leaves me with the theory questions. So let's look at the theoretical questions. Let's look at the practical questions. Let's see what is happening in this. The net profit of Rainbow Limited as per its statement of profit and loss account for the year ended 31st March 25 amounted to 27,22,000 after debiting and crediting the following items. People, PGBP question. So I'm starting this as my net profit. This is my starting point. Let's look at what does the question want from me. The question wants from me the total income of the company chargeable to income tax, ignoring the provisions of 115JB. The company is not opting for any kind of concessional regime. So I'm in the normal tax regime. Good enough. No tax rate has been requested for. So my normal net profit has been given to you. Move forward. Payment of interest on money borrowed from bank for purchase of land is 2 lakh rupees. The land was meant for construction of a factory building and for which the approval from local authority is pending as on 31st March 2025. Borrowing cost standard people. Borrowing cost comes and says when you have any kind of interest, you have to be capitalizing the interest until the asset is put to use. Since the building has not raised its approval on 31st March 25, this land interest should have been capitalized and therefore I will disallow this. Cannot be claimed as an expense. Next, a commission of 1 lakh rupees is paid in the month of February 25 on which tax was deducted in February 25 itself. Good, tax deducted, all good. Commission of 1,25,000 paid in the month of March 25 on which tax was deducted in May 25. I have a problem here. People, when a rule of 40 IA comes in, comes and says that when you deduct TDS, you have to deduct TDS in the respective previous year itself, which means 31st March of the previous year. If not, then you will be disallowed for the same and allowed on the year of the payment. Even if the payment happens before the date of return filing, if the deduction did not take place before 31st March, it is a disallowance. So which means I'm going to look into this and this is going to be disallowed. This is going to be disallowed for 30%. For 30%. Tax deducted at source on these payments was deposited to the government on 28th September 25. Now I am looking at this condition only for the purpose of my first payment. My first payment of 1 lakh rupees should have been done before due date of return filing. It has been done on 28th September, therefore I am fine. I have no problem here. So this means the 1,25,000 alone is going to get disallowed for a 30% tax rate. So 30% disallowance. So 1,25,000 into 30% gives me 37,500 rupees. So disallowance comes up here. Yes, although people, if you come and ask me, nowhere have they mentioned that this person is a payment made to a resident. Yes, so this is an assumption which I am probably making. It doesn't mention anywhere that it's a resident payment of commission. I could have assumed that this is a payment made to a non-resident also, in which case I would have disallowed the 100%. So it's a choice given to you. A traveling expense of 90,000 rupees on a foreign tour of a director for negotiating collaboration with the foreign manufacturer for initiation of a new business line. You see this? If you have a new business line and any expenses are incurred for the same, these expenses are treated capital in nature. This is not allowed as a deduction. It has to be disallowed. I could have only claimed this as an expense as a business expense if it was for the existing business. New business lines, capital expenditure not allowed as deduction. As a part of the restructuring of its debts, the company has converted arrears of interest of 3 lakh rupees on term loans into a new term loan which was revised payment schedule. The company has paid only 50,000 rupees under this for the year. 3 lakhs is fully debited to P&L account. People, 43B has a specific circular to this. 43B has come and clarified that when a person is converting its interest into loan, it does not tantamount to payment of the interest. It is only claimable as a deduction when the actual payment has been made. Since 3 lakh rupees has not been paid off and only 50,000 rupees has been paid off, I should have only claimed 50,000 rupees as deduction. Claiming the whole 3 lakhs is wrong and therefore I will be disallowing the whole 3 lakh rupees, but in turn can claim the 50,000 rupees. In turn can claim the 50,000 rupees as a deduction, perfectly allowed. Next, on EPABX and mobile phones which are exclusively used for business purposes, depreciation amounting to 18 lakh rupees was claimed at 40%, treating them as computers. Here comes the case law. The case law comes and clarifies that when it comes to EPABX and mobile phones, you are not permitted to claim 40% of computer depreciation. You can only claim 15% of plant and machinery depreciation, which means the 18 lakhs claimed by you is wrong. Let's reverse this off. 18 lakhs divided by 40% gives me 45 lakhs. 45 lakhs into 15% is what I should have claimed. So 6.75 lakhs is what I should have claimed, but I ended up claiming 18 lakhs and therefore 11.25 lakhs will be disallowed in the current year. 11.25 lakhs will be disallowed in the current year. Next, 5 lakhs being the contribution to S Limited wholly owned subsidiary for construction of a school for the benefit of its employees. Now people understand, from my side this is a payment to my subsidiary. From my side, this being a payment to my subsidiary is not a CSR expense from my pocket. What the subsidiary does with it is not of my consequence. And even if you call it a CSR expense, people, at the end of the day the benefit was done for its own employees. When it's an expenditure incurred for its own employees and there is no capitalized benefit coming out of this, this is an allowable expense. No disallowance here, fully allowed as deduction. We have discussed about this adjustment multiple times in classes. Next, dividend received from P Limited on 10,000 equity shares of 10 each purchased at 100 per share on 10th October 2017. The rate of dividend declared is 100%. Record date being 10th December 2024. Okay, so I have received dividends, people. Let's check how much dividends I have received. I have received 10,000 worth of shares into 100 rupees. no, 10 rupees is my share price, and therefore 1 lakh rupees is what I would have received as dividends. Now, because this is credited to my P&L account, I will have to remove it from my P&L account for the purpose of computing PGBP. While computing IFOS, I can claim this as an income. Yes, so in IFOS, I will report this as an income. In PGBP, I'm going to reduce this as my income. Next, the shares were sold on 15th March 2025 at 130 per share. People, shares have been sold off also. So this looks like a capital gains. Shares were purchased in 2017. Shares has been sold in March 25, which means this is a long-term capital gain under section 112A. Is it? Do they mention STT has been paid? Okay, no mention of STT payment, so I can call it as 112 also. Although people, if you notice carefully, on 2018 they've given you 110 rupees. When they're giving you 2018 or a number, the assumption would predominantly be that this looks like an 112A case. Although nothing has been mentioned about the shares being paid for STT people, and therefore I can always make an assumption that this is not an STT paid company. Yeah, so this is a choice of thought. This is choice of thought. You can decide to either call it as an STT paid entity and therefore tax it under 112A, or you can decide to treat it as a non-STT paid entity and you can decide to tax it under 112. Now, Rahul, what is the significant difference? The significant difference is on this part. If you're going to treat it as 112A, this FMV versus the sale value will be compared whichever is lower and will be taken into consideration for the cost of acquisition whichever is higher. Yes, so if it was that case, I would have taken 110 or 100 whichever is higher. So 110 would have been my cost of acquisition, whereas if you're calling it as 112, then in that case I will not call it 110. I will treat the same 100 as my cost of acquisition and tax it accordingly. So you make a choice on what it is, people. Both the answers should ideally be right as long as you write the notes. Next, provision for gratuity based on action. Oh, by the way, before I go forward, let me also clarify this. The long-term capital gains of 3 lakh rupees is credited in the statement of profit and loss account has been given. So therefore, I have to remove it from my PGBP statement as well. Yes, let's remove the 3 lakh rupees from PGBP. And then when you do long-term capital gains, you can decide whether you want to do 112 or you want to do 112A. Either way works. Next, provision for gratuity is based on an actual valuation of 6 lakh rupees and was debited to P&L account. However, actual gratuity paid is only 1,50,000 during the year. People, 40A7 comes into picture. 40A7 comes and says disallow the whole provision for gratuity and claim only the amount which you have paid off as a deduction. So 1,50,000 can be claimed as a deduction. Next, provision for bonus for the year 23-24 was paid on 15th November 24 as 98,000. It is inclusive of the payment of bearer check by 34,000 to 1 employees. People, when it comes to bonus, last year you would have not claimed as deduction because of 43B implications. Since last year you would have not claimed this deduction because the payment was only made on November, in the current year when you have made the payment, you can claim it as a deduction. However, please note the fact that the payment also has some 34,000 paid to 1 employee, and therefore 48.3 gets triggered. 48.3 would come and say that because you're only having this payment in the current year, that too by bearer check, I will not permit this expense because it is more than 10,000 to 1 person to in one day, and therefore I can only claim the net number as a deduction. So it is 98,000 minus 34,000 for me as a deduction. So 64,000 will be allowed as deduction to me in the current year. Yes, great. The company has purchased and put to use a commercial vehicle of 8 lakh rupees for the purpose of the business on 21st March 2025 and has calculated depreciation at the rate of 15% for the full year. Here is where I see a problem. Notice that the asset was put to use only on 21st March. Because it is put to use on 21st March, I should have only claimed 50% of it as a depreciation. Depreciation debited to profit and loss account is calculated on all other assets as per the rate prescribed. So this is wrong, people. I have a commercial vehicle of 8 lakh rupees. In this 8 lakh rupees, I have claimed 15% depreciation, which is 1,20,000. I should have not claimed 1,20,000. I should have only claimed 60,000 rupees. Therefore, I will disallow the 60,000 rupees. I will disallow the 60,000 rupees. On all other assets, they are telling that they have done it as per the income tax rules, and therefore I have no problem. I am ignoring all those depreciation otherwise. So this is what your adjustments will look like, people. Let's see what IC has done on the adjustment sheets. I just wanted to check on the capital gains piece. So yes, 27-22 is what our starting point is. My 2 lakhs of money borrowed because I told you the asset is not put to use. Commission paid for the February month has been ignored off because it is paid on time. If it is March, I have disallowed 30%. See, they have done 30% on the assumption that this is a resident payment. Traveling expenses has been disallowed because it is capital for a new business. Loan converted is disallowed for 2,50,000 because 43B comes into picture and can only claim the actual loan repayment. 11,25,000 has been disallowed like we discussed because only 15% of it can be claimed as a deduction. Contribution to S has been allowed as deduction because, like I said, it is not in my hands what is happening with the payment. Maybe the subsidiary will not get a CSR benefit on this, but at the end of the day, I will be eligible for the payment. Next, 6 lakh rupees has been disallowed for provision of gratuity, 1 lakh 50 has been claimed as provision for gratuity payments. Depreciation on commercial vehicles disallowed for 60,000 because you should only claim half of the depreciation. Long-term capital gains is removed because it has to be taxed under capital gains. Bonus of 64,000 has been claimed as deduction only because I have 34,000 worth of numbers, so 34,000 is not allowed as deduction, so removing that, everything else has been claimed as deduction. Dividend of 1 lakh rupees is moved to IFOA, so therefore reduced from PGBP. Looking at capital gains, notice, see, they've taken it at the rate of 12.5% on a sum exceeding 1.25 lakhs, which means they've reported this as 112A. So this is an assumption made from their side that they're wanting to report it as 112A. You can make a choice to also report it as 112 by stating that STT was not confirmed whether it was paid or not paid. Income from other sources, 1 lakh rupees has been taxed as it is. That is what the chapter looks like. Yes. So this is your full mark compulsory question of 14 marks. I hope you were able to understand this question. If you're able to crack it from your side, then amazing. If not, please make notes of whatever mistakes you've made in your book and therefore make sure that you don't repeat this in the exam times. Let's forward it up. We have question number 15, which says Shanti Foundation is a charitable institution. We're looking at taxable or charitable organizations, which is registered under 12AB and is engaged in the preservation of forest. Okay, 215. The accountant of the institution provides the following details to you as a chartered accountant. You're required to discuss the tax treatment of each of the independent situations in the hands of charitable institution for 24-25. Answer should have the reasoning of it. The institution as follows mercantile system of accounting and during the previous year 24-25 has incurred an electricity expense of 1,20,000 during the year 24-25. The electricity expenses were actually paid only on 15th April 2025 through an account paycheck. In which year such expenditure will be treated as application? People, straightforward question. 12AB has come and very clearly confirmed that when it comes to section 12 and section 11, you can only claim application on basis of cash. Only cash basis of application is allowed for you. You cannot have accrual system of accounting. Cash payment is only allowed as deduction. Because the payment has happened in April, I can only claim this as a reduction in previous year 25-26. I will not be eligible for it as a deduction in 24-25, claim it only in 25-26. The foundation was cultivating 15 acres of agricultural land from agricultural operations. It has earned 10 lakh rupees during the year. Whether an exemption under 10(1) can be claimed? Yes. This is something which we have discussed in class also. When it comes to charitable organizations, no other exemptions are allowed to you except for agricultural income alone. Agricultural income alone can be claimed as an exemption. Everything else will be denied to you because you have to make sure that the 85% is applied for the purpose of the objects of the trust. Shanti Foundation has earned rental income for the year 24-25 amounting to 4 lakh rupees. It has received 3 lakh rupees up to 31st December 24 on such income. However, the balance 1 lakh rupees was received only on 31st August 25 next financial year. Up to what period the institution can apply the same towards the object of the trust? The institution has exercised the option of has exercised the relevant options in this regard. People, because the institution is going for an accrual system of accounting, this unfortunately would have been part of the income statement. But since the money has not been received, there is no opportunity for me to apply this as an income, and therefore income tax gives you a special benefit. You can decide to treat this as application in the current year, provided you make sure that the payment of this has been applied in the next year in which the money is received or the year after that. Because I have received the money in 31st August 25, I should either ensure that the money is applied in financial year 25-26 or at least in financial year 26-27. If it is not happening, then in the end of financial year 26-27, I will end up taxing this income as a specified violation. Until such time, I will not have any implications. So in 24-25, I will assume it as application. In 25-26 or 26-27, if I apply this money off, then I'm safer. Otherwise, I'm caught for the problem. Yes, great. That's for charitable organizations. Let's look at question number 16. In respect of the following independent scenarios, you're required to discuss the provisions of TDS or TCS. Okay. Mr. Raju has purchased scrap of 55 lakhs from Mr. Sandeep for the purchase of his manufacturing unit and has credited to them in the books of accounts. Raju has furnished a certificate to Sandeep that the scrap will be utilized for manufacturing purposes carried on by him and will not be taken for trading purposes. People, TCS rules comes into picture. 206C1 comes and clarifies that when there is a scrap, there is normally a TCS applicable. However, if there is a declaration which can be given which confirms that I'm going to use it for further supply, which means I'm going to use it as a part of my manufacturing operations, in that case, I will not be liable for TCS under section 206C1. Raju has made the payment of 45 lakhs to Sandeep. Assume the turnover of both Raju and Sandeep are beyond 10 crores. This becomes the catch point. Now people, because TCS under 206C1 does not apply, you have another section hiding in the back. You have something called 194Q. Even though Raju is not going to have a TCS, Mr. Sandeep is now liable to do TDS because Sandeep is buying this No, sorry, Raju is liable to do TDS because Raju is buying it. So Raju will have to do TDS on Mr. Sandeep for a price of 0.1 percentage on the price exceeding 50 lakhs, which means 5 lakh rupees. So on the 0.1 percentage on the 5 lakh rupees, he'll have to do TDS at the rate of 0.1 percentage. TDS 194Q will apply in this case. You can't avoid it. Yes, great. Mr. Rajat has took a loan of 20 lakhs from his employer, Josh Private Limited, an Indian domestic manufacturing company, for sponsoring studies for his daughter in Australia. Out of the said loan, he has remitted 9,75,000 towards fees to the university in Australia for his daughter's education. We are again looking at TCS LRS scheme coming into picture. The remittance was made for LRS scheme. Now people, LRS scheme has certain rules. The rules says that when you are going to transfer money outside India for educational purposes, I will ask you a question. Tell me, are you covered under section 80E? If yes, then I will give you 0.5 percentage of TCS. If not, then I'll give you 5 percentage of TCS on a sum exceeding 7 lakh rupees. Here I have made a payment of 9,75,000 rupees. Because I made a payment of 9,75,000 rupees, 7 lakhs is anyway not liable for TCS. The balance 2,25,000, I'll have to ask that whether I've taken a loan from 80E or not. In this question, they have mentioned that they've taken a loan from an Indian domestic manufacturing company. Here is where the issue starts. People, 80E comes into picture only when you're taking a loan from financial institutions. If you're going to take a loan from an Indian domestic company, that is not an 80E provision. Because it is not an 80E, your loan is of no consequence to me. I will treat it as a normal education payment, and therefore 5 percentage will apply on this, which means the answer is I'll be deducting TDS at the rate of 5 percentage on 2,75,000. On 2,75,000, I will be liable for a TCS. Are we clear? Yes? Okay. Great. Question number 17, people. Question number 17 says, Samaksh Limited filed its return of income under the section 139(1) on 15 September 23 for 23-24. Within timelines, good enough. The return was found to be defective and an intimation was issued on 10th May 2024. Okay, next financial year, directing the assessee to rectify the defects within 15 days. The defects were rectified on 19th May 24. The return of income was processed and an intimation was sent on 15th July 24. Subsequently, the assessing officer has issued a notice under section 143(2) on 21st June 2025. People, this is your case law question. Your judicial updates has this. The question has come up is that when it comes to return filings and you have to issue a notice for assessment, it has to be done within 3 months from the end of the financial year in which the return is filed. The question which came up before High Court is that, can you go and tell that my defective notice has been filed in the next year? So the defective return which was corrected in the next year, that is the year from which I will issue my due date, issue my assessment notice. Answer is no. This High Court and then Supreme Court in SLP case has also come and confirmed saying that just because a defect has been rectified in a return does not mean a new return has been filed. The return is still taken the consideration from the original return. My original return was filed on 15 September 23 and therefore the end of the financial year will be 31st March 24. Within 3 months will be 30th June 24. Within 30th June 24 is what you should have issued the notice for 143(2). You have issued the notice on 21st June 25. This is the next financial year. Your notice is time barred. You're not getting the notice assessment done. CA of Samaksh Limited content in the notice was time barred by limitation since it is issued beyond the permissible limits. Examine the validity of notice. The answer is yes. The CA is correct. The assessing officer has no powers to issue the notice because he has breached the timeline. He should have issued the notice by 30th June 2024 and not in the next year. He cannot take the defective return as the starting point. He has to take the original return as the starting point to issue his notice. Are we clear? Yes. Great. Question number 18. Mr. Kabil has filed his return of income of 25-26, declaring an income of 35 lakhs on 2nd June 25. He has opted out of default tax regime. Question itself says he has opted out of default tax regime. On processing of the return, the total income determined under section 143(1)(a) was 45 lakhs. Okay, so he has processed the return. 143(1) has been issued to him. Thereafter, on scrutiny, the assessing officer made some additions on section 140(a) and section 43(b) and has passed an assessment order under section 143(3), assessing the total income at 85 lakhs. Okay, so 45 lakhs is now converted to 85 lakhs in the assessment. Later on, the assessing officer has issued a notice under has noticed that there are certain income escaping assessment and has issued notice for reassessment under 148. The total income reassessed is 1.05 crores. So number has jumped. Considering that none of the additions or disallowance were made was qualifying as 270A6 for non-levy of penalty, you are required to compute the amount of penalty to be levied under section 270A at the time of assessment under section 143.3 and at the time of reassessment under section 147, assuming that none of them is on account of misreporting. A question which has come 101 times, people. This is something which is always tested. What is the answer? Very simple. How much did I have in my 143.1? I had in my 143.1 a 45 lakh rupees income. 143.3 has how much? 143.3 has 85 lakh rupees worth of income, which means I have underreported income to the extent of 40 lakh rupees here. I have underreporting of income for 40 lakh rupees here. Then if I go to 147, I have underreportings of 1.05 crores. So 1.05 crores minus 85 is what I will check into picture. So it is 105 minus 85, the answer gives me 20 lakhs. So another 20 lakhs is also called as my underreporting of income. Can penalty be levied to you? 101%. What is the problem here? The only thing is penalty will be levied at the rate of 50% of the underreported taxes, because that is what is happening. This is not a misreporting. How do I do this, people? Take the 45 lakhs, go for slab rate model. Go for slab rate model, find the tax payable. Take 85 lakhs, go for the slab rate model and find the tax payable. Please note carefully, then when it was 85 lakhs, you will have a surcharge at the rate of 10%. You will have surcharge at the rate of 10%. So you have to apply the surcharge on the second item alone, and then you have to compute tax on this. Reduce the tax payable which is coming as per 45 lakhs. The difference of that you have to pay 50% as penalty. When it comes to 147, the income has become 1.05 crores. Therefore, you will now have a surcharge at the rate of 15%. So you will take the tax on 1.05 crores at the rate of 15%. Reduce the tax of 85 lakhs, whatever you have received. The difference of that will be called as my underreported taxes, on which you have to tax at the rate of 50%. Yes, I think this is a fairly easy question, people. You should be able to do it yourself as well. We have seen so many of these questions in the past as well, so it should not be a challenge for you. Yes, great. Looking at question number 19. Question number 19 says Diamond Lux BV is a foreign company incorporated in Belgium. Okay, it is engaged in diamond mining and trading of raw diamonds. People, this is again from my statutory updates. We have a new important update for safe harbor rules, where safe harbor rules basically come and say that if you're a foreign company engaged in the mining of diamonds, then whatever your income is there, if you're ready to report at least 4% of it as a PGBP income, then I will not be scrutinizing you for transfer pricing cases. It sells raw diamonds globally. During the previous year 24-25, it has sold raw diamonds to Indian buyers in special notified zone. This becomes important for me. For 100 crore rupees. An exhibition was taking place in special notified zones in Surat, Gujarat for display of uncut and unassorted diamonds. Okay. Diamond Lux BV has the income of 10 crores from activity of display of uncut and unassorted diamonds. People, before I go for safe harbor rules itself, let's understand when it comes to section 9, business connection has a specific exemption which says that if you're a foreign company which is just coming here and displaying uncut and unassorted diamonds, I will not be taxing you in India. This will not be treated as an income accruing in India or arising in India, and therefore this income is fully exempt. This income is fully exempt, not liable for tax. Diamond Lux BV wants to exercise the option to apply the safe harbor rules. It wants to declare the profit of 3 crores from trading of raw diamonds to Indian buyers and a profit of 2 crores from display of raw diamonds. First of all, this profit of 2 crores was never taxable in India. What is the point of reporting it? Not required. Forget it off. On the 3 crores piece, people, I have a problem. Understand, my total turnover is 100 crores. I should have reported 4% of it, which means minimum 4 crores should have been reported for the purpose of safe harbor rules. Whether Diamond Lux is eligible to opt for the safe harbor rules? If yes, can it declare profit of 3 crores? No, it cannot declare a profit of 3 crores. Do you have to report a profit of 2 crores? No, you would be stupid to do that. 2 crores was anyway not taxable in India, so there is no requirement for you to report the 2 crores. 3 crores would not be liable for safe harbor rules because you need to at least report 4 crores for this case. Yes, so a very, very beautiful question. You should have looked into it. Question number 20 is my last question. Yes, this looks like a DTAA question, and this is one of the most complex questions I've seen, people, because it has a different ambit to it. Let's see the question, you'll understand better. It says Mrs. Kanika Tandon is a popular Indian pop singer. She has a business interest in country X and is country Y as well. She is a resident in assessment year 25-26. The details of the income which is earned by Kanika Tandon from India as well as country X and country Y, with which India does not have a DTAA, is given to you. When India does not have a DTAA, people, we are doing average tax rate in that country versus average tax rate in India, whichever is lower. I have an income from house property computed, good enough given to you. 4.3 is my India, 1.3 is my foreign. Can I report my income as the net number? Yes, I can report my net number as well, because I will have my income from house property. I'll have my income from house property. So I can report the net number as 3 crores in my income from house property. No challenges here. Business income, I have 9 lakh rupees from India, 11 lakh rupees from Y. So therefore 11 crores can be reported here. From being the owner of cricket teams, Delhi Super Players, 5.5 crores can also be reported here. No problems here. Other businesses are 7.2 and 2.9. How much does this become? 7.2 plus 2.9, total becomes 10.1. Share of income from a partnership firm not evidenced by an instrument in writing. People, this is one assumption which ICI has been taking on multiple occasions. ICI has an assumption that when it is share of profit from a partnership firm, it is only exempted if it is treated as partnership firm in India. If it is not a partnership firm from India, ICI has made an assumption that these are taxable incomes in India, and therefore this 4.8 crores will also become taxable. Next, agricultural income of 1.5 crores and 1.2 crores. This is what I was talking about. This is a big issue now because 1.5 crores is exempted because it is Indian income. 1.2 crores being taxable, that is fairly understood. But the problem here is, people, you are doing DTAA. When you're doing DTAA, please note carefully, an agricultural income has a tax rate. We are talking about partial integration. A partial integration needs to be done in this question, which you may not end up doing in the exams in a hurry. So this is what you may have gone wrong for. So pay attention to that. Mrs. Kanika has deposited 1.5 lakhs in PPF and has paid life insurance premium of 1 lakh. People, both together will be giving you an ATC of only 1.5 lakhs. You can only claim a maximum ATC of 1.5 lakhs. That is what you're getting. Next, in country X, share of income is not exempt and loss from house property is not eligible for being set off against the other incomes. So share of income is not being exempt. The set off of losses is not being granted. Country Y, agricultural income is chargeable to tax. So it is taxable there also. It is taxable here also. This is a double taxed income. In country X, Mrs. Kanika has paid an income tax of 2.1 crores and in country Y, they have paid an income tax of 2.44 crores. You're required to compute the net tax liability, assuming that she's paying tax under default tax regime. Whatever. If it is default tax regime, forget the ATC, nothing is coming to you. No ATC is coming to you. ATC is gone for all. ATC is gone for all. That is what is happening. But the second challenge is, people, if I notice the incomes here, the incomes are huge. I have 11, 5, 16, 26, 30, 30, 31, 32, 32.1, 32.6. So I have 32.6 crores worth of income being reported. That means I am now liable for a surcharge, and the highest rate of surcharge under default tax regime, which is 25%. 25% worth of surcharge also needs to be taken into consideration. Yes. Now, before I go and give you the answers on this, people, let's discuss a few things. First, how much is my average tax rate? My India average tax rate can be found out after I compute my whole computation, so that's different. But looking at my average tax rate on the other countries, I have ended up paying 2.16 crores on country X. On the country X, 2.16 crores. Tell me, what is my double taxed income? My double taxed income is only going to be these two. My double taxed income, sorry, not my double taxed income, my income taxable in that country is only going to be these two, because the question has come and confirmed that the 1.3 crores was never claimed as a set off. So my average tax rate would be 2.16. So it is 2.16 divided by 7.2 and 4.8 will give me 11 and 12. So which means there is an 18% tax rate in the country X. So my country X has a tax rate of 18%. Yes, but what is my double taxed income is the question. Double taxed income is going to be 7.2 plus 4.8 minus 1.3. Understand, while 1.3 was not allowed as a set off in country X, it is still allowed as a set off in India. Because it is allowed as a set off in India, there is no reason for me to call it as a double taxed income. It is still permitted for a set off, and therefore my double taxed income would be the 12 minus 1.3. Yes, so I will take 7.2 plus 4.8, 11, 12, 12 minus 1.3 will be taken. Therefore, the answer is 10.7. So I will be treating my double taxed income as 10.7 here. Coming to country Y, my country Y, my income is 2.44, and that is getting divided by what? That is getting divided by 2 plus 2.9, which is 4.9. 4.9 plus 1.2 is also there. So it is 6.1. Yes, it is 6.1. So therefore, the income is 40%. I have a tax rate of 40% when it comes to country Y. What is my double taxed income? My double taxed income is all the three, people, because singing is also taken, 2.9 is taken, 1.2 is also taken. So my doubly taxed income here is going to be the whole 6.1. The whole 6.1 will be taken into consideration. Here is where you have to pay attention to. So basically, in this case, there are a couple of things which you need to keep in mind. One, a surcharge rate of 25% will apply. Two, no ATC deduction is coming because default tax regime is being opted for. 3, your losses of HP can still be set off against income from HP. No problems here. 4. When it comes to tax rate, I will be checking the tax rate based on the tax rate of country X, where the tax divided by the incomes alone will be taken because the loss was never set off. But when it comes to doubly taxed income, I will take the doubly taxed income as 7.2 plus 4.8 minus the 1.3 because 1.3 was claimed as a set off in India. That is what you need to keep in mind before you go forward. So this is going to be a good question. And yeah, last thing which I already told you, agricultural income will require a partial integration. Yes, so if I show you the answers very quickly, people, let's see what is happening. So I have income from house property 4.3, loss of set off 1.3 has been set off, so 3 crores is allowed for me. PGBP incomes have been taken, 14.5 crores is reported. PGBP income of country X has been reported, and if you notice, the share of income from firm is also treated as a taxable component. Income from country Y is also taken as a taxable component. 31.4 crores is what my income has come from PGBP and HP included. Income from other sources is coming in. I have 1.2 crores of income from other sources because my India agriculture income has been exempted. The balance is alone taken into consideration. My gross total income becomes 35.60 crores. No deduction under chapter 6A because you have a default tax regime being opted for. Notice, to do my tax rates in India, they have considered the partial integration concept. So I'm starting from here, where I'm taking the both incomes of agricultural income and normal income. Then I'm computing income on the basic exemption limit plus the agricultural income. And then I'm finding out my final tax payable as 10.67 crores. 10.67 crores after partial integration. On this partial integration, I'm applying a surcharge of 25%, applying a cess of 4% to arrive at an income of 13.87233. Yes, this is what is happening. Now, to arrive at my doubly taxed income and average tax rate, notice what they've done. I've taken the 2.16 crores and I've only divided it by 12 crores because I will not take my loss for the purpose of computing my tax rate. So 18% has been taken that way. But when it comes to country Y, I'll take the 40% because that was a simple one. India tax rate has come to 38.967%, which is nothing but the tax rate which you arrived at, divided by the income, which is 35.60 crores. Yes, that is how you have arrived. Now, when it comes to this, you can obviously easily understand. When it comes to India versus X, I will take X. But when it comes to India versus Y, I will take India. Because whichever is lower. For the doubly taxed income, people, you will take the 7.2 plus the 4.8, but you will also remove the 1.3 crores of the HP loss because that is not a doubly taxed income. But when it comes to the other country, you can take the whole 6.1 crores itself. Taking that into consideration, you found your double taxed income as 4.3 double taxed relief as 4.3 crores, and therefore your final tax payable has come to 9.5693130. Yes. Now, I did it in a hurry, people, because I want you people to practice this question rather than listening to me alone. So please go ahead, practice this question, see if you're able to click this answer because it's a very good question for you to practice from your end. Are we clear? Yes, perfect. This marks the conclusion of what we call as the RTP series of your CA final direct tax September 2025. A very good paper is what I would say, people, because your statutory updates were tested, your judicial updates were tested, and they did test you on a couple of things here and there where they could have tricked you easily well. So yes, an RTP paper which you can really pay attention to and see if you're able to crack it off from your side. As we progress forward, I will also be giving you videos on the MTP series, which is going to come up for the MTP series 1 and MTP series 2 as well. But before I do all those things, like I tell you always, please try it once from your end before you come and watch the video so that you also have a confidence that you're able to crack it from your end. But yes, I will not stop my job, people. So I will definitely ensure that we are back with the video so that you can also be engaged and understood on whatever is important from our side. That is my promise, so that you can all do well. Until such time, people, if you have any kind of feedback, any kind of suggestions, any other chapters which you think I can support you with, please drop it on the comment section and I'll be happy to support you on those as well. Until we meet for the next time, take care, bye and happy learning.